Hi everybody, and welcome to today's Facebook Live. I'm Tina Powell, coming to you from Beacon Wealth Management, and today we are going to be talking about volatility. That's right, volatility. We changed things up a bit. Originally we were going to talk about Roth IRAs. We'll bring that to you next time, but being that there's been a lot of volatility in the market, we thought that that would be a better topic and that you will absolutely enjoy today's broadcast. So, of course, I'm joined by Mark Germain, CEO of Beacon Wealth Management, who will be explaining volatility to us. And again, this will be a great learning opportunity. In addition, before we started with the program, you know I just have a minute of housekeeping, so please hang on and let's get that out of the way. Today is Thursday, March 29th, 2018. The time is 3 p.m. Eastern Standard Time. This Facebook Live is being recorded, so please remember this broadcast is just giving general advice and opinion. So any performance numbers are historic. You must put your own personal situation into perspective and speak to an investment professional, ideally somebody who knows you personally and who knows your goals. So with that, let me introduce you to Mark Germain, and we will start talking about volatility. Good afternoon, Mark.
Thanks, Tina.
The VIX is back.
The VIX is back, and I think we did do the disclosure. I think that's really important. We'll talk a little bit about what market volatility really is. We're going to talk about how is market volatility measured, or how does the average person measure volatility, typical emotional responses to market volatility, and then Beacon's response to market volatility, which may be very different than yours. And I think the easiest way to explain market volatility, or volatility in general, is to take yourself a 12-inch ruler, hopefully metal, a nice metal ruler, and I want you to put it over to the edge of the table. And I want you to pull down on that ruler as far as you can, holding this side, and let it go. And it's going to do this, and it's going to do this, and it's going to up and down. That's volatility. Okay? That things do go up and they do go down. And that's exactly what volatility looks like. And that's the way you need to think about it, is it's not much worse than snapping a ruler on the edge of the table, is that things are going to go up and they are going to go down. And in the market today, and in the market in history, we've always had volatility. So what has happened in the last 6 weeks has made people very, very nervous, mostly for the wrong reason.
So Mark, will you give us the standard academic version, definition of volatility, and then I know you have some really great graphs that will help our listeners to really illustrate what it all means.
So market volatility, everyone today measures volatility and they call it the fear index, because people are afraid of volatility. Yet it is volatility that has allowed people to make money over time. It is commonly used by investors and traders alike to gauge the stock market expectation of volatility, and that is called the VIX. And the VIX is nothing more than a series of indicators combined to come up with one index that is supposed to measure volatility. It really measures volatility of future activity. So volatility as implied by the composition of index options. So it is referred to as the fear index. We talked about it as nothing more than that gauge. Now, this is what happened on 2/5/18 to the US VIX. On 1/2/18, it was 9.7, seldom less than 10. It was 37.32. Yesterday, it was 22.50. Remember the ruler? Here it is. It's up and down. And one of the things that has most people frightened, the fear index, is that they haven't had any volatility for the last 2 to 3 years. It's been very low. Now all of a sudden I have all this volatility, so the sky must be falling in. It isn't. What's caused all of this massive volatility. And this is showing the VIX 2018 year to date compared to other years. So as we're looking at it, we have a lot of years, and 2017 is in here, where it's literally no volatility.
It almost looks like a monster up there, right? Or a hand coming out. It's so we haven't seen volatility like that in so many years.
What's causing it? One, the up market or the bull market is 9 years old. Okay? All of a sudden we have tax law changes. We have geopolitical items going on that are scaring people. Hence, the index starts to go up. We have a new Fed chairman, came out, raised interest rates. Everything spikes. So volatility goes up from actions, not necessarily from the fundamentals of the investment that you might be making. So kind of some of the important rules that you need to remember. Okay? It can be measured, we talked about it, and we could get into all the statistics. I am not going to bore you with statistics. We could state the formula of the mean of the difference of the standard is really the standard deviation. It's the squared, and then you divide it so you come up with a positive number, and it's great fun to calculate the standard deviation. What's it mean? It means how much of this action actually happens. As we're talking about that ruler, the higher the standard deviation, the more this thing is going up and down, the ruler.
So Mark, not to interrupt, but here you're talking about the difference of the volatility of the stock and then the volatility of the market, which you just explained. So is it possible to have a portfolio in a volatile market that is not really volatile?
There are things that are less volatile, and it's very interesting that you can find things. Well, obviously, if you were in the FANG stocks over the last couple of weeks, your stocks were doing this. And everyone that wanted to sell Facebook the other day, it's now up 4% today.
Right.
So it's part of the market. And that's what people need to recognize, is that when volatility becomes a problem, your advisor should be telling you volatility is now showing us that the market is getting riskier. But that is not really. It's been responding to incidents in the market. And what happens? Typical investor responses. You want to get nervous and sell. We had a client call, I have to get out of Facebook. I said, well, I don't think that's really a good idea. Nope, I have to get out of Facebook, and she sold at a lower price, now it's at a higher price. Keep calm and understand what is the objective of what you're in. I want to go to cash. Well, we know how much cash makes, 0. And with inflation going up, it makes less than 0. It's actually going backwards. Okay, so what I want you to do, Mark, is I want you to sell and buy back in, which is called timing the market. So I'm going to have anyone in this room raise their hand if they think timing in the market works. No one's raising their hand. No one is listening raising their hand. Why? It doesn't work. Okay, we have a lot of newsletters that have told people, get out, sell. They never come back and tell you when it's time to buy, so you miss the uptick. It's impossible to consistently time the market. Anyone who tells you different doesn't know or is lying to you purposely. So if they say we're going to time the market, tell them they can't. Okay? Rules to remember. I think that's really where we want to go, right?
I think that is absolutely true. I think that's our, before we close,
yeah,
the 4 important rules that you want to share and that we will remember in the spirit of volatility.
Yeah. So it's kind of 3 in 1, right? We'll call it 3 rules in 1. Upturns and downturns are all part of investing. It is going to be there. 2, and this is the single most important thing that you can remember relative to volatility and what is happening in the market, is you want to stay focused on what your long-term goals are. If your goals are short-term, you may want to pay attention to volatility. If you want to be a stock trader, then get yourself a seat downtown in New York City and become a stock trader, and you can watch volatility and trade that stock all day long. If what you are doing is setting an objective to educate your kids, buy a home, retire, then you have a long-term goal. And in order to do that, you need to stay invested and you need to stay focused on what your goal is. Are you reaching your goal? Has your portfolio, even with the ups and downs, increased at your expected rate of return? What did I need to have enough money to educate my children? I needed it to grow by this number. Is it growing by that number? If it is, you're meeting your target. Stay focused on that goal. Look at the returns and the data points in your portfolio. So what happens is a lot of people say, oh my gosh, the market is so far off and volatility is so bad, I need to get out. Well, you don't have that in your portfolio. You don't have that volatility. You're 80% in bonds, which are going up. So it's really important to understand what's in your portfolio. So remember those things. And then, if you're not sure, get in touch with your advisor. Get in touch with a person that you trust, that gives you investment advice, that manages your portfolio. And if it's us, there's our phone number. There's my email. Get in touch. Ask the question. We had a client in yesterday. He was very nervous. He wanted to get out because one of his friends said, go to cash. And we told him what our benchmarks were, what we were using, when we would get out. And he says, okay, I'm convinced. It's worked till now. I'm going to go with you.
So just because your advisor hasn't done anything or hasn't made trades during volatility doesn't mean that they're not watching it like a hawk, right?
Let's go back one slide, right?
Yeah.
You can't time the market.
Right, exactly.
So when the volatility hits and the market drops is not the time to sell. It's time to buy.
Well,
okay.
Thank you, Mark. I think that was a great insights into volatility, and you heard it here first. If you need some answers, speak with your own financial advisor. Hopefully, they're a CFP, a certified financial planner like Mark. Mark's number here is 201-447-9500. His email is mark@bwmllc.com, and we have other specialists on the team as well. So thanks for joining us. Everybody have a fantastic Thursday, and we'll talk to you soon.
Thank
Bye.
you.